Bandhan Mutual Fund presents MF Corner.
Hello and welcome to the special edition of Mutual Fund Corner on YouTube. And today what we're going to discuss now and keeping it going with the conversations is going to be on long-term investments that you can make in mid and small cap funds, mutual funds. How is the strategy that one should follow? What is it that one should follow? Risk that is there that when you invest in these funds, what is the return that one could expect? What is the time horizon that you could have for these investments as well? And to talk about that, today we have a special guest joining in with us on the show. We have Mr. P. Padmanaban, who is joining in with us, the director at Fortune Investment Services Private Limited, to talk to us about this topic. Thank you so much, sir, for joining in with us, and it's a pleasure having you on the show. You know, the key nowadays has become that the small and mid cap, overall when you look at it, they've seen a lot of volatility in the recent times. While at one point of time they were outperforming the benchmark indices, we have seen them fall also equally and underperform the benchmark indices. As a mutual fund strategy, if someone wants to play this story, what are the factors that investors should consider before investing in mid and small cap mutual funds, especially for a long period of time?
Okay, thanks for the opportunity given. See, for example, if anyone wanted to invest in a small and mid cap investments, the minimum tenure should be 5 years upwards. So if somebody is not in a position to stay for more than 5 years, they should not come into the mid and small cap investments. So if you look at the last 5 years, 7 years, 10 years, the best large cap fund is equal to the worst small cap fund performance. So just being the category itself, you will generate more return. So if you look at the 5, 7, 10 years, all the time, the worst small cap fund has done better than the large cap funds. That is number one. Number two, the volatility, as you rightly said, volatility is very, very high. For example, if you take a big drawdown in 2007, 2008, the global financial crisis, the large cap corrected roughly about 55%, mid cap around 60-65%, and small cap corrected as high as 70%. But when it comes to pullback, it has also come very, very fast. In the recent COVID correction in the year 2020, the large cap fell around 35%, mid cap around 40%, small cap as high as 50%. But exactly 1 year later, from 50% fall, it has given 2x return. So it will cover all the returns. The only challenge is during the fall, you should have the ability to hold. That is why we always suggest whenever you are investing in a small cap, mid cap investments, better you invest through a professional, because whenever the market is down, in fact, there are a few investors are asking in the recent fall, roughly about 15% between September 26 and now, and most of them are asking, no, can I get down? Can I get out and can I re-enter and all those things. So if you are investing through the professional, they will tell you, so no need to worry, this is how the market works, and definitely you can make a very good return. So anybody who is coming for a 5+ years, definitely it is worth coming to the small cap, mid cap investments, and you can make a lot of money compared to the large cap funds.
Absolutely. Long-term view, 5+ year view, then it makes a sense, you know, in terms of managing the volatility also that one could see in. But mid and small cap mutual funds would be a good option. 5+ year is your time period. You know, sir, what I want to understand, while we did speak about how market volatility actually impacts this mid and small cap mutual funds, what is a strategy that an investor could follow to mitigate the risk over a long period of time? Now, obviously, one thing you said that, you know, go through a professional, so they will be managing it. But if someone is individually doing it, what is it that one should keep an eye out on to mitigate these risks?
Yeah. See, if somebody wanted to invest in a mid and small cap on their own, so first they have to understand when the market, whether the market is all-time high or the market is at a discount. Say, for example, if you look at September 26, that time the market was high. That was the time you should not put one-time investment. You should stagger it. Say, for example, if you have 100 rupees, probably you should have put 50 rupees and you should wait for another 50 rupees in a staggered manner. Today, the market is 15% down as an index level. But if you look at the individual stock level, there are stocks which fell more than 30, 40, 50% also in the recent fall. So if somebody is investing today, so they can straight away invest some 60-75% straight away, and 25% they can stagger it. And somebody who is doing a SIP, so SIP is a all-time product, because when you invest last month, you invested, let us say 10 rupee. That time you got, say, let us say 100 units. Now the market is down, you will buy more units. So in the SIP, when the initial period is not generating more return, most of them tend to get out of the SIP. But that is not the exact thing they have to do, because in the initial period, if your SIP is not doing well, you accumulate more units. Eventually, 5 years, 3 years later, the market will go up. So automatically, you will generate more return. So this is the another risk mitigation. Third thing is, suppose you invested, let us say you invested majority of the amount in September 26, let us say 80% of the money. Now still you have few more money to invest. What you can do, you can stagger it, and you can make use of this opportunity. So you keep investing. So these are all the mitigation, because long term, definitely you will get a good return, but in the short term, you should have the ability to accept the volatility and stay invested.
Absolutely. Sir, I just want to understand one thing. Historically, right, you did mention some bit of a performance for 5 years plus for mid and small cap mutual funds. But historically, if I have to compare them with long-term mutual funds, how do the returns stand, both in a bull market as well as a bear market? Anything specific that we are watching out for in terms of a difference here?
Yeah. See, whenever the bear market, definitely the fall will be more. For example, if you take a two recent scenarios, right, as I pointed out earlier, so the drawdown is very huge in 2008 global financial crisis, as well as in 2020 also. But when it comes to bounce back, it has generated a huge return. So whatever it fell, it will automatically compensate. So one should not look at only the bear market return, and we should not come to any conclusion, because the market, there are three types of scenario. One is a bull market, and another is a bear market, and another is a sideways. So normally it will be 1/3, more or less equally. So one third of the portion is only in the downtrend. So you should make more money in the sideways as well as in the uptrend. This is number one. You have to understand. And second thing, as I pointed out earlier, if you look at the last 5-year large cap fund, top fund return is 18%. The worst small cap fund return is 18%. The best one is around 40%. And if you look at the 7 years, so 7 years, the best large cap fund generated around 14%. Worst small cap fund generated 14%, and the best fund has generated more than 20%. In the 10-year period, the best large cap fund generated only 13%, whereas the worst fund has generated more than 13%. And there are so many small cap fund, at least 10 funds have generated more than 20% in the 10 years. So as long as your investment is long term, see, in fact, most of the investments are long term. People are investing for their child education, child marriage, their retirement. This will not be 1 or 2 years. It will be minimum a decadal investment. So one should not worry about the short-term volatility as long as your long-term goal is intact. So you invest aggressively in a small and mid-cap funds, because that is what the result says.
Sure. Sir, what about assessing the quality as well as the potential of mid and small cap funds? How should the investor go about that, particularly in terms of fund manager performance, portfolio composition? What is the importance of all of this, and how should the investor assess it?
Yeah. See, actually, if somebody wanted to invest in a small cap and mid cap, the first and foremost thing what they have to do is they have to select the fund which are reasonably smaller size. It need not be very, very small. It should be reasonably small. You should not go to the fund which is very, very big. But most of the time, what will happen, the individual investor, they will look at the fund, because the bigger fund size have a lesser expense ratio. So many of the investor, their objective is to invest the fund which is having a lesser expense ratio. But that is a very, very bad approach. See, because, for example, in a small cap fund, the biggest fund, the fund AUM is more than 63,000 crore as we stand today. And if you take a mid cap, it is more than 70,000 crores. Okay. For example, earlier, before 2023, most of the fund manager is having a 50 to 60 stock portfolio. That's the average portfolio. Somebody will have a concentrated portfolio, roughly about 30 stocks. So generally, if you look at the last 20 years or so, the general stock is 50 to 60. Now, most of the stocks, if you look at, everything is more than 100, 150. Some of the fund will have more than 200 stocks. So what will happen? Suppose if the fund size is 60,000 crores, even if they take 1% of the weight on the particular stock, 60,000 divided by 1%, which is a 600 crore stock. So 600 crore stock in small cap is very, very difficult. And if you want to accumulate that particular stock, or if some bad news comes, you will not have the opportunity to exit that particular stock. So the point is, if the fund size is less than 5,000 crore or between 2,000 to 5,000 crore, the fund manager have the ability to maneuver between between one stock to another stock, and they can generate more return. So the active fund management will happen only if the fund size is decent. But if the fund size is very big, it's very, very difficult to generate higher return. So you have to understand the fund size, and more importantly, the fund manager experience. So the fund manager, whether the fund manager is a new fund manager or the fund manager is an experienced person, now he is handling this particular category. That is important. And finally, the fundos. Okay. To me, fundos will be the last priority. You should not give first priority to the fundos. First is the fund size. Second is the fund manager. Third will be the fundos. So likewise, if you can do it, so definitely you can select a good funds. And there is nothing called buy and hold. For example, if you select a fund, today the fund is doing very well. And most of the time, what we will tell, 15% is a good return. Yes, 15% is a good return. But at the same time, in a year, there are funds which have generated 40-50%. You should also look at your fund performance. If your fund performance is not to that, then you should be in a position to move out of the funds. So in my style of working, no fund will be there forever. So probably 2-3 years, one fund, and you should move to the another fund. Likewise, the long term is very, very important, but not on the same fund.
Sure. Okay, sir, thank you so much for joining in with us on the show today and explaining our viewers of what they should be keeping an eye out on when they are investing for the long term in the mid and small cap mutual funds, and what are the risks that are there as well. Thank you so much for joining in with us.
Thank you. Thank you so much.
Bandhan Mutual Fund presents MF Corner.